PharmD Nation, what are capital gains taxes? Why are they something you need to be aware of? And how do capital gain taxes align with and work with the other taxes you incur throughout the year based on the other income sources you earn? Well, to answer the first question, capital gains taxes are the tax on any profit you earn after the sale of some sort of asset. Most commonly, people experience capital gain taxes when they sell some sort of investment inside their investment portfolio, stock, bond, or something else. For example, let's just say 3 years ago you bought XYZ stock for $10,000. This year you sell that same stock for $20,000. You realize a profit of $10,000. You would owe capital gains tax on that $10,000 of profit. Now, how does that align with the other income you could potentially have and the other tax liability you could potentially have throughout the year? Well, I think it's really important to understand that capital gains taxes do not affect or increase your ordinary income taxes you owe based off of something like W-2 salary you own from your job. Let's just say you are a pharmacist household and your taxable income from your job is $150,000. Let's say also you sell some sort of investment inside your taxable account for $30,000. You're going to owe capital gains tax on this and ordinary income tax on this. Capital gain assets and tax stack on top of your ordinary income tax. So it really doesn't matter if you have any of this, a lot of this, or some of this. This is going to get taxed the same. But since this goes on top of your ordinary income tax, this and how big this is will determine how much of this will be taxed at whatever capital gains tax rate you fall into for that year. So to make a long story short, just know that capital gains taxes are different than ordinary income taxes, and that if you have a large capital gain tax due within a year, make sure not to inadvertently increase your ordinary income tax too much at the end of the year through something like an IRA distribution, because that could have a negative effect on how much capital gain tax you could potentially have to pay on that profit of the sale of some sort of asset you made in that given year.